Can you get a VA loan with as low as a 500 credit score? The short answer is yes, but the question you're probably asking is how? You see, if you've spoken to the big box lenders like Veterans United or Navy Federal, which don't get me wrong, are fantastic companies with their hearts in the right place, you're probably hearing information from them that says you actually cannot get a VA loan if your credit score is under a certain number. And while there may be some truth to this, the thing you need to understand is not all lenders are created equal. And instead of them telling you that you cannot get a VA loan under a specific credit score, they should probably tell you that in order to get a VA loan with their company, you need to have a specific credit score. So in this video, I'm going to tell you what the actual minimum credit score is per the VA handbook. Then I'm going to tell you what most lenders are looking for in order for you to get a loan with them. I'm going to reveal what is required in order to qualify. And yes, I'm even going to show you how to get a VA loan if you have a credit score as low as 500. If you don't know who I am, my name is Josh. I have been educating and facilitating VA loans for the last decade, and I have helped thousands of families utilize the VA home loan benefit using the very tips and tricks that I talk about on this channel and specifically in this video. So if you want to stay up to date on all the tips, tricks, and hacks that go into the VA home loan benefit, how to leverage your VA loan and even build wealth, subscribe, join the community. It's completely free and you'll be able to stay up to date on all the options that are available to you. All right, let's jump right into the minimum credit score that the VA expects you to have in order to get a VA loan. It's actually 0. The VA has in their handbook a specific line that says there is no minimum credit score in order to get a VA loan. But the thing that you need to understand here is the VA actually does not do loans. The VA only guarantees the loan, which means the VA is there to say who can or who cannot get a VA loan. So then now you're wondering, well, if the VA says it's 0, why do these other lenders tell me a specific number? That's because these are called overlays. Yeah, as I mentioned, the VA states who can and cannot get a VA loan, which means in their guidelines, they're going to have certain rules and requirements that all lenders must meet in order to loan money. However, lenders have the ability to take those very rules and add their own rules on top of them. These are what's called overlays. It's the requirements that each lender has in order to get money from them. The thing you want to understand next is overlays cannot weaken the VA guidelines. They can only make them stronger, which means they must use the minimum requirements that the VA has in place. And then if the lender wants to make the rules stronger, then they have the ability to do that. Now, what do most lenders look for when it comes to the minimum credit score with the VA loan? Most of them are right at about 620. There's even some as high as 640, but I would say that most lenders, almost everywhere you look, is more than likely going to have a minimum credit score of 620. And then you'll also find lenders that will go as low as 580, which is not going to be as many, but there are some that will allow you to go lower. Now, if you work with someone like myself, who's a mortgage broker, we can potentially allow you to go as low as 500 as long as you meet another set of requirements, which we'll talk a little bit more about later. The next thing I want to dive into is how lenders are going to qualify you. What a lot of people misunderstand about credit is they think that it is looked at in the same light as when you are applying for an auto loan or even a credit card, when really it's just one of a few other items that determine whether or not you qualify for this home loan. When you are applying for a mortgage, the lender is looking at several things other than just your credit score. They're looking at your income, assets, monthly debts, and also your credit. And then what they're going to do is figure out how much money you have coming in versus how much you have going out for those debts. This is known as either debt to income, or also for a VA loan, it's what's called residual income. Debt to income is a percentage of how much money you have coming in versus how much money you have coming out, whereas residual income is based on how much money you have left over after all of your bills are paid. Now, you're probably thinking these are one and the same, but really they're actually completely different. You see, in the VA handbook, the VA does not have a minimum debt to income ratio for final decision making. What VA is looking for is that you meet the minimum residual income amount. And that amount is dependent on, first, where you're located geographically, and second, your household size. So depending on where you're located and also how big your household is will determine how much the VA expects you to have left over after all of your bills are paid. And this could potentially equal a very high debt to income ratio, where if you were getting any other type of loan, could potentially disqualify you right off the bat. Why? It's simply because those other loans have debt to income limits. If you're getting a conventional loan, that debt to income limit is 50%, where if you are getting a FHA loan, the debt to income ratio is 57%. When it comes to VA, they're solely focused on the residual amount. But if you're working with a lender that has overlays on top of that debt to income ratio, well, then that's where you're probably running into the issue of also not being able to qualify. Some lenders are going to still have those debt to income caps no matter what you do, whereas others like myself aren't going to have that debt to income cap when it comes to your ability to qualify with the VA loan. What the lender's going to do next is they're going to submit your file into what's called the automated underwriting system. The automated underwriting system is going to look at all of the 4 variables we mentioned earlier: income, assets, monthly liabilities or debts, and also your credit score. When it's looking at these things, it's going to determine a pass or fail grade, which means means that it's solely there to determine risk on whether or not this thinks it is a good loan. The thing you need to understand is this system is actually not the final say on whether or not you're able to qualify for a VA loan. This system is simply there to determine a risk classification, which means that in many ways, this risk classification can be a little bit more conservative than the potential aggressive options that could be available, which means that in some cases, you could have the automated underwriting system overturned. If your file is submitted to the automated underwriting system and it does not give an approval, this is actually not the end of the world. This is just step one in terms of a lender's job to determine whether or not they can or cannot approve your loan. You see, if the automated underwriting system does not like your file, the next step that your lender should be doing, if you're working with me, is going to be looking to see if they can do what's called a manual underwrite. A manual underwrite is where we take your file and submit it to an actual physical underwriter that is going to be there to determine whether or not we can overturn the automated underwriting system. Now, this doesn't guarantee that the underwriter is going to overturn what the system states. It's just simply there to see if maybe the underwriting system was being a little bit more conservative than it needed to be, which means that if the file that is in place meets the VA's guidelines, it could potentially overturn it. So now let's dive into how a manual underwrite works. You see, within a manual underwrite, one of the first things that this underwriter is going to be looking for is compensating factors. These are essentially things that are going to help strengthen the file and show the underwriter why it should overturn the system's decision. One thing that they're going to be looking for as a compensating factor is what's called a VOR, a verification of rent. This verification of rent is going to look at the last 24 months of rent payments to make sure that if you have been making those payments on time, it provides strength to the file to show the underwriter that you are obviously able to manage a monthly housing expense. The next thing it's going to be looking at on that VOR is how much that housing expense is, because what they don't want to have happen is what's called payment shock. Payment shock is where you are going from, let's say, $1,000 a month for rent, and then now you're looking at buying a property that is $2,000. That's more than double what you are currently paying, which means that you are potentially going to be put in a worse financial position by purchasing this property, and they're wanting to look and see that they're not putting you in a worse position to potentially default on this mortgage. So if you are buying a property and your rent is $2,000 and your mortgage is even potentially $2,500, that has a much higher likelihood of getting approved for simply the fact that it is not looking like payment shock is actually being caused here. Some of the things that they're going to be looking at are late payments. Even though you may have a 500 credit score, what they want to see is how have you been acting as a borrower for other liabilities on your credit in the last 12 months. If you have large amounts of late payments, this could be the one thing that can deny a loan no matter how high or low a credit score is. I have seen situations where someone has several late payments within the last 12 months be denied even though they had a 670 credit score. But I've also seen situations where someone has a mid to low 500 credit score, but with no late payments in the last 24 months, get their loan approved. This is what I would say is arguably going to be the second most important thing other than that VOR with regards to getting an underwriting decision overturned. Now, don't get me wrong, having 1 or 2 late payments within the last 12 months does not automatically deny you, but it does raise some red flags or concerns with the underwriter. What they're going to be looking for is what's called a letter of explanation. A letter of explanation is a short letter simply explaining to the underwriter how this happened and what you're going to do to make sure that it doesn't happen again. Some of the other compensating factors that will strengthen your file other than your VOR, avoiding payment shock, and not having any late payments within the last 12 months could also be stable work history, which could be you working in the same line of work for a long period of time. It could even be low consumer debt, where maybe you have a low credit score, but you've basically paid off all of your monthly revolving debts for like credit cards and you don't have a lot of high monthly expenses. There's actually a very long list of what compensating factors could be, but those are going to be the most common ones that will be used or at least expected. So now you know having a bad credit score doesn't exactly disqualify you from being able to get a VA loan. It just maybe raises a little bit of a hurdle that you need to be able to navigate in order to be able to qualify. If you got value from this video, please do me a favor, hit the like button down below so that it gets shared to more veterans like you who need to know this information. And if you also didn't already know, Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you in the next one.